Welcome to the Deep Dive. We're your shortcut to getting properly informed. Today, we're digging into a whole stack of sources, especially the Nutstuff reports. We're aiming to cut through all the noise, find those surprising connections, and really help you understand the big global shifts and investment frontiers. Ready to get beyond the headlines? Let's jump in.
Yeah, it's fascinating how these reports let you see beneath the surface, doesn't it? It's not just random fact, it's about connecting the dots. That's what we want to help you do today.
Okay, so let's start with the UK. The sources we've got paint this picture of, well, a real paradox. On the one hand, it's like just another English summer, everything seems normal. But underneath, there's this phrase they use that really sticks with you. Hearing the splintering joists of a country living beyond its means. Powerful stuff.
It really is, and it's not just flowery language, is it? It points to real economic strain. The report suggests this idea of just about managing isn't niche anymore, it's mainstream. You've got mortgages resetting much higher, energy bills just climbing and climbing, and the energy grid itself is apparently, one cold snap away from crisis.
Wow.
Yeah, and what comes through strongly is the sense of drift, like no plan, no margin for error, no grown-ups in charge. That's a direct quote. Even something like concrete demand dropping to its lowest since 1963. It's not just a stat, you know? It signals that the basic belief in building for the future, well, it's kind of stalled out.
And that links straight into what the reports call the property farce, doesn't it?
Yeah.
This whole idea, this illusion of home ownership, it seems pretty broken for a lot of people. They talk about stamp duty being a huge problem for older people.
Absolutely.
Like, imagine wanting to downsize, but you got to give, what, 50,000 pounds straight to the government just for the privilege of moving?
Yeah, it just stops people. And then at the other end, you've got young people earning peanuts, as the report puts it. How are they supposed to find 40,000 pounds for a deposit? It's like the whole market is seized up.
Yeah, neither end can really move.
And it's not just the stamp duty, actually. The reports point to those 5-year mortgage deals from back in 2020. They're described as detonating like landmines now.
Detonating?
Yeah. Monthly payments apparently jumping by 400%. I mean, just imagine that. So this isn't just, a typical market correction. It's leading to what the source calls a quiet exodus of the middle class. People looking at alternatives like getting residency in Lisbon.
Right. The whole dream is evaporating.
Exactly. It forces a complete rethink.
Okay, so from the economy, the sources then pivot pretty sharply into immigration. And it's a really charged topic, obviously. They don't just focus on the numbers, but on what Nutstuff calls the utter indifference of the political class.
Yeah, like they just want to waft away an awkward smell. That's the phrasing used.
But the signs of strain are there, aren't they? Tent cities sprout, HMOs, houses in multiple occupation are overflowing.
Right, often packed way beyond what they should be.
And you see unemployed young men drift through town centers. It's presented as more than just optics. It's a warning flare.
And this touches on a really difficult point about social cohesion. The reports mention the Muslim question and grooming scandals as an open wound. They suggest communities closed ranks, politicians avoided the issue, and the result, according to Nutstuff, is 2 worlds now live in parallel, neither speaking the other's language.
That's a stark image.
It is. And they argue that what some call tolerance actually looks more like surrender. The really provocative bit is the conclusion. Solutions might exist, things like mass removals or cultural honesty, but they're seen as politically unthinkable.
So no easy answers presented there. And that stuff really digs into the political economy side of things, too. They argue that just hiking taxes might not actually bring in more money.
Yeah, the Laffer curve idea, basically.
Right. It could just lead to net contributors leaving the country.
Precisely. And they tackle that common argument that low-wage immigration helps with the fiscal time bomb. Nutstuff argues the opposite, that these immigrants often cost the public purse way more than they will ever contribute.
So what's their suggested alternative?
Get youngsters back to work instead. That's the line. And the UK net migration numbers they cite are pretty dramatic, going from negative migration back in the 70s to over 2 million net arrivals between 2022 and 2024. That's a massive shift in a short time.
Huge shift. Okay, so while the UK picture looks, pretty challenging, let's zoom out to the global markets because they seem to be telling a different story, right? For now, anyway. Party's still going.
It certainly looks that way on the surface.
Yeah, you've got the FTSE at new highs, S&P 500 up, 15% year to date, NASDAQ 100 up 20%.
Driven by the usual suspects, the big tech stocks, the AI excitement.
And just a lot of froth of cheap money, as the source puts it.
But there's a warning in there, too. Historically, August and September can be tricky months. They call them graveyards for optimism. Thin trading, potential for nasty surprises, sharp sell-offs.
Right. So keep an eye out. But for now.
For now, yields and spreads aren't showing much stress, surprisingly. The 10-year Treasury is around 4.27%, 30-year under 5%, and corporate bond spreads. They're described as the narrowest ever, only 75 basis points over Treasuries.
So it looks quiet, but maybe too quiet?
Maybe. It suggests complacency, perhaps.
And this brings us to that generational divide the reports talk about. It's quite striking. You've got the smart money on the beach, apparently, not glued to the screens.
Yeah, and the boomers on the golf course. They bought houses when they were cheap, rode rates down to zero, and retired as the music stopped. That's the narrative.
While Gen Z is left sweeping up the smashed glasses, wondering if they'll ever own a home.
It does highlight a stark contrast in experiences and opportunities. And this actually leads into a really fascinating idea from Vincent Delord over at StoneX. He argues the business cycle itself is structurally broken.
Broken. How so?
Well, the old kind of recession where you need big inventory clearouts, capital destruction, it's less likely now because the economy is so different, right? It's like 80% services, 35% government spending, and a $5 trillion gig economy.
So the old mechanisms don't bite in the same way.
Exactly. The structure's changed.
So who does the creative destruction now, if not recessions?
That's the interesting part. The argument is that private equity and venture capital have kind of taken over that role. And there's another layer, the politics. It's seen as politically impossible now to let asset prices fall too much because of retirement accounts.
Right, everyone's 401k or pension.
Yeah. And you can't inflict too much economic pain because of, well, aging voters. So the conclusion is pretty stark. Policymakers will do whatever it takes, prevent recessions at all costs.
That's a huge claim. It changes how you think about investing, doesn't it?
It really does. If the old cycles don't apply, well, you need a new playbook. And speaking of new playbooks, this is a good point to pivot to the digital revolution, because that's definitely reshaping things.
Okay, so what does this all mean? Digital assets, AI, where are we heading? The sources suggest big changes. Bitcoin's dominance is apparently slipping a bit.
Yeah, money's flowing into Ethereum and other altcoins. And the key message is decentralized infrastructure isn't abstract, it's happening.
Right, it's becoming real.
Exactly. They point to things like helium, HNT, building decentralized wireless, or Solana-powered DePINs, that's decentralized physical infrastructure networks. The suggestion is pretty bold. The next Mag 7 could come from 5-7 blockchain protocols tied to physical infrastructure.
Like telco, energy, compute.
Precisely. Real-world stuff, built on blockchain, moving beyond just speculation.
And what about Bitcoin itself? Still decaying.
Well, the report calls it a work of genius, inevitable as gravity. Pretty strong words, but you still get the well-heeled types who are scared of it, right? Worried about quantum computing or hacks.
Well, Bitcoin itself is just carrying on.
Yeah, stretching its legs, yawning at $114,000 is how they put it, calling it the easiest long in the history of longs. And the numbers are hard to ignore. 67% compound annual growth over 10 years, a sharp ratio of 1.21. That's serious performance.
Okay, so let's talk about these Bitcoin and Ethereum treasury companies. What's the deal there?
Right. The sources say, yeah, they may wobble, but that's expected. The wobble is part of the dance. The crucial thing is they don't really have short-term debt, so no margin call on the debt.
So less vulnerable to those sudden collapses.
Exactly. Their volatility is actually framed as an opportunity. You get higher beta, potentially higher returns, plus this unique ability for fast BTC accumulation.
Yeah.
And they have this party trick, the Bitcoin-denominated bond. Apparently, one big investor, a whale, can completely transform their balance sheet with one of those.
And they're attracting serious capital.
Oh, yeah. In 2025 alone, the report says these companies added over 157,000 Bitcoin, that's like $16 billion, and raised over $33 billion in capital. It's not fringe anymore.
Definitely not. And then there's Ethereum. Tom Lee's making some big bets there.
Huge bets. The report quotes him saying, Wall Street has already decided Ethereum is the chain they're going to build Wall Street onto.
Wow. Building Wall Street onto Ethereum.
Yeah. And his ambition, to own 5% of all Ether by 2026.
5%? How much is that?
About 6 million ETH. Roughly $20 billion today. And he's apparently buying aggressively below $10.
And his predictions for ETH are optimistic.
Understatement. He thinks it has a 100x upside, that it could even flip Bitcoin.
Flip Bitcoin. What would that value be?
Potentially $40 trillion, according to his view. which would make companies holding lots of ETH, like BM&R, potentially one of the world's most valuable companies.
That's a staggering prediction.
It is. It's a vision of Ethereum becoming the base layer for institutional finance.
Okay, let's shift to another company mentioned. Galaxy, GLXYUS, described as sitting at the crossroads of crypto and AI.
Yeah, two obsessions of our age, as the report puts it.
Yeah.
The digitized philosopher's stone of crypto and the half-terrifying, half-messianic promise of artificial intelligence. They've got Bitcoin, yes, a treasure chest of it, but also land for potentially the largest data center in the known world.
But the market's not fully seeing it yet, ignoring it.
Seems that way for now. But look at their deal with CoreWeave, providing AI compute $1 billion a year for 15 years. That's massive.
So they're not just a crypto play anymore.
Not at all. The report says no, they're basically an AI landlord now, controlling power equivalent to roughly the electricity consumption of Belgium.
An AI landlord, that's a fascinating shift.
It shows how these worlds are merging. Crypto, AI, energy, data centers, it's all becoming interconnected infrastructure.
Okay, and on AI itself, beyond the infrastructure, what's the current reality versus the hype? Everyone talks about robots coming for our jobs.
Right, that's the standard narrative. But Nutstuff offers a more grounded take. For now, they say, right now, AI can't do anything on its own. It needs a human to tell it what to do, and another human to check its work.
So it's more like a tool, not a replacement.
For now, yeah, they call it middle to middle, handling the dull bit, the donkey work, like an oddly efficient temp in a call center.
But with a big caveat.
A huge caveat. But that's only for now. The potential is clearly there, just maybe not in the way the headlines scream about today.
Got it. Now, connecting this back to investing, you mentioned the need for alternatives because of money supply growth.
Exactly. The M2 money supply, broad money, has grown about 7% a year for the last decade. So if you get a guaranteed 5% return after inflation, you're actually losing 2% in real terms.
So you need something else, an offset alternative.
You do. And that's where things like DeFi, decentralized finance, are starting to look interesting again.
Because it's maturing.
Yeah. The report says DeFi is now finally achieving traditional business economics. You've got protocols actually generating revenue, making profits, like Sky, which used to be MakerDAO, or Hyperliquid.
So real businesses are emerging at that intersection of artificial intelligence and blockchain technology.
That seems to be the key takeaway. Real opportunities moving beyond just hype.
Okay, shifting gears again.
Yeah.
Because you can't ignore geopolitics and all this. Let's talk about Donald Trump's return to the world stage. The reports mention this. Peculiar agony. Some feel in admitting he might be getting some things right.
Yeah, despite the bad manners, as they put it.
So what are the points they highlight? Domestically, the border crisis is described as largely diffused.
The economy keeps humming along, maybe despite or perhaps because of his tariff tantrums.
And NATO allies.
They've suddenly found their wallets, started paying up after his demands. Apparently his direct approach worked there.
And the Middle East. He backed Israel against Iran's nuclear program.
Without, as the report notes, blundering into another Middle Eastern quagmire so far. So a mixed but interesting picture, according to the source.
But then there's Ukraine. That sounds much more concerning.
Deeply concerning. The sources frame Russia's main goal as a dismantling of the nationalist Ukrainian armed state, which clashes directly with Europe wanting an army it can't afford.
And if that dismantling doesn't happen?
The outlook presented is grim. Russia might just stop a bit further inside Ukraine and then steadily Oreshniks Ukraine until little is left. Oreshniks being those hypersonic missiles. It's a bleak assessment.
Very bleak. And how does Trump's style fit into this, his deadline diplomacy?
Right. He's apparently told allies he wants to meet Putin, then do a three-way meeting with Zelensky. And he loves deadlines, doesn't he? The report says he collects deadlines like hotel shampoo. So he's apparently put this 10-day countdown aimed at Putin.
But are these deadlines real?
Well, that's the question. The report points out they're often elastic. Think about TikTok, Iran, the Canada trade wars. Lots of noise, then maybe not much happens. They get filed under never happened.
But applying that to Moscow.
That's where the warning comes in. Moscow deals differently. Deadlines there are met not with diplomacy, but with diesel and death. The report is incredibly blunt. Pointing a rifle at Putin is not a metaphor. It's simply a national psychotic episode, given Russia's nuclear capability.
So incredibly high stakes.
Bias.
And the unpredictability. There's that anecdote about Apple and the tariffs. Can you walk us through that? It sounds wild.
It really illustrates the chaos. So Apple tries to carefully move production out of China to India, right,
Yeah.
to avoid huge 140% tariffs. Big PR push about diversification.
Makes sense.
Then Trump comes back and proposes a 25% tariff on basically everything not made in the U.S., even stuff from India.
Ouch. Undercuts their whole move.
Completely. So Apple panics, announces this hilarious $600 billion investment in the U.S., which, as the report notes, is like 14 times their total capital spending over the last 4 years.
They're not entirely believable.
The source calls it arguably a hostage letter.
Wow.
But it gets worse. Right after that, India gets slapped with 50% tariffs because they were buying cheap Russian oil. So Apple's entire diversification plan, gone. Wiped out by one signature from a man who thinks TikTok is a Chinese missile program.
That's chaotic.
The quote describing it is priceless. Watching a blindfolded aged orangutan play Jenga with a foreign policy guide, it captures the sheer unpredictability.
Okay. So amidst all this macro chaos, let's dive into some specific market niches where the reports see opportunities, where it gets really interesting, as they say.
Right, let's get into the weeds a bit. First up, oil. The focus here is offshore.
Offshore. Why?
Well, OPEC's cuts, even when they unwind, are seen as bullish because there's basically sod-all marginal supply left in the world. Even when they produce more, those time spreads stay stubbornly tight.
Meaning the market needs the oil now.
Exactly.
Yeah.
Meanwhile, the E&Ps, the exploration companies, they're hoarding cash. Shale output looks like it might be peaking, but offshore, it's making money even at today's prices. And crucially, no one is building new rigs.
Ah, so future supply looks tight.
Very tight. The prediction is the next offshore boom will be even tighter, nastier, and more profitable because the cheapest new barrels are still out at sea.
Interesting. Okay, what about batteries? Always a hot topic.
Yeah, they mention Enovix, ENVX US, a very clever battery technology evolution play. Think batteries for things like Meta's new smart glasses. Stock's been weak, but analysts apparently have high price targets, and you have Elon Musk talking about gigantic demand, potentially doubling U.S. energy output.
Sounds transformative. But there's always a but, isn't there?
There is with batteries, according to Nutstuff. They argue batteries are not the answer for large-scale grid storage. They do the math on lithium. To back up one big 1,000 milliW coal plant for just 100 hours, you'd need 32,000 tons of lithium.
Okay. How much lithium do we produce globally?
About 155,000 tons in 2024. So a whole year's global production would only back up that one plant for about 18 or 19 days.
Right. That puts the scaling challenge into perspective. It's massive.
Huge limitations that often get glossed over.
Okay, moving to biotech. Often a source of endless disappointment, as the report says. They highlight Cardiol, CRDLUS.
Yeah. Their drug trial results caused the stock to drop 20%. Why? Because one measure showed a favorable trend, but the p-value was 0.0538. Just missed statistical significance.
And algorithms don't like nearly.
Algos don't do nearly, exactly. But the report digs deeper. The crucial buried detail was that left ventricular mass actually fell significantly. It indicates reduced heart inflammation for acute myocarditis, and that's a condition with no approved treatments currently.
Ah, so the headline reaction missed the real potential.
Classic biotech story, right? Hope, disappointment, rinse, repeat, until someone, as they say, actually reads the data.
Fascinating. What about mining? Power nickel, PMPN, CN.
This sounds like a big one. They had a game-changing drill result. Get this, 6.97% copper equivalent over 32 meters.
That sounds good.
That sounds amazing. A raw textbook grade stuff, the report calls it, and the location was key. It was 800 meters off trend from their main lion zone, which suggests the whole area could be connected, shaping into a full system, a much bigger discovery.
So they're shifting strategy.
Yeah, from just prospectors to cartographers of a major discovery. They're drilling more. Stock's already doubled, and analysts are putting out some pretty high price targets. Suggest they might be onto something significant.
Okay, quick look at Europe now.
Yep.
Rockets and satellites. AVIO and Eutelsat?
Yeah, AVIO's stock jumped recently. And Eutelsat, which people might think of as a dusty old satellite company, their low Earth orbit LEO sales are booming, up 84%. It's now 15% of their revenue, could be half by 2028.
So it's becoming a growth story.
An actual growth story, yeah. But look at the valuations. AVIO trades at maybe 1.5 times revenues. Compare that to Rocket Lab in the US at 25 times revenues. Right. Or Firefly valued at $6 billion for, quote, no reason anyone can fathom.
So the market prefers the hype.
Seems like it prefers the shiny American thing that hasn't quite blown up yet over the boring Italian one that actually works. Even though the French government invested in Eutelsat at a higher price. Market irrationality, maybe?
Happens all the time. And finally, an unlikely success. Crocs and Hey Dude.
The platonic ideal of anti-shoes, those rubbery confessionals.
They've built a huge business, haven't they? The billion-dollar empire, including the Hey Dude brand they bought.
Yeah, it seems improbable. But the report asks, why are ugly shoes still a beautiful business?
And the answer.
Good old-fashioned fat margins and the fact that cash pours in. Eyes are on the upcoming earnings, especially for Hey Dude's performance, but the core business seems surprisingly resilient.
Okay, so bringing this all together, there's a really strong theme about a generational divide, especially in how people approach investing.
Absolutely. Nutstuff talks about the boomer mentality, those who simply won't retool. You just can't take 1983 out of the man.
Meaning they stick to what they know.
Exactly. And this apparently leads some established hedge funds to flounder. They look at things like Bitcoin, tokenization, AI, DeFi, depin, and they dismiss it. They're like, no thanks, mate. I'll stick to my Microsoft, BP, and gilts.
They're missing the shift.
They're missing a massive shift, according to this perspective. Because the secret is their own 20-something analysts are all secretly long tokens, depend in dodgy coins, and are short their boss.
Huh.
That's the claim. It illustrates this fundamental change happening under the surface, a new investment philosophy that the old guard is maybe too busy being way too clever to notice.
Wow. Okay, we have covered a ton of ground today.
We really have, from the cracks showing in the UK, the weirdness in global markets, the whole digital asset and AI revolution.
The geopolitical chess games, those deep dives into specific sectors like offshore oil, batteries, biotech, mining.
It's been quite a tour.
And hopefully, by digging into sources like Nutstuff, we've given you that shortcut, that advantage in understanding this incredibly complex world.
That's the goal, to help you connect those dots.
So let's leave you with a final thought to chew on, direct from the source material. The all-encompassing crisis above, of course, won't arrive with a bang. It will seep inch by inch until suddenly everyone pretends they knew it all along.
Makes you think, doesn't it?
It does. So the question for you is, what are those small, incremental changes happening right now? The ones that might be tomorrow's seismic shifts.
The things that maybe others are too busy being way too clever to notice.
Exactly. Keep looking, keep questioning. Thanks for joining us on The Deep Dive.
Catch you next time.
Disclaimer. North Breach Limited, Nutstuff trading name, is an appointed representative of Messels Limited, which is authorized and regulated by the Financial Conduct Authority. Nutstuff has made every reasonable effort to ensure the information provided in this communication is correct. But Nutstuff makes no representation nor any warranty as to whether the information is accurate, complete, or up to date. To the extent permitted by law, Nutstuff accepts no responsibility for any errors or misstatements, negligent or otherwise. Nutstuff, its associates, officers, or employees may also have interests in the financial instruments referred to in this information by acting in various roles. The information in this media is confidential. If you are not the intended recipient, you are not authorized to use the information in this media in any way. Nutstuff does not guarantee the integrity of any media or attached files. The view or opinions expressed are the author's own and may not reflect the view or opinions of Nutstuff. Electronic communications carried within the Nutstuff system may be monitored.